Think the IRS can't track your crypto? Think again. The IRS has been stepping up its game, and with the new regulations on the horizon, they're about to get even more information on your transactions. If you've been flying under the radar, it's time to get informed before it's too late. Hi, I'm Andrew Gordon. I'm a CPA, attorney, and crypto investor. And for the past 10 years, I've been in the trenches, helping crypto investors navigate the complex world of IRS reporting, avoid audits, and defend against criminal investigations and severe eggshell audits. I see firsthand how the IRS targets taxpayers, and today I'm here to share some critical updates on how they track cryptocurrency. Back when we recorded the original video, I chose this as a topic because many, if not most, crypto investors thought the IRS had no way of tracking most crypto transactions, at least not until they cashed out. But this is a common misconception that I still hear from crypto investors in consultations almost every day. When we made a video on this topic 2.5 years ago, it was one of our most popular videos, but a lot has changed since then. One of the most significant developments is the new final broker regulations from the IRS, which will require exchanges to report trades to the IRS. So how does the IRS track cryptocurrency? A lot has changed in the crypto world since we recorded a video on this topic 2.5 years ago. So I wanted to share what's changed, what hasn't, and why knowing how the IRS tracks crypto is more important than ever before. Let's review the previous video.
I know what you're thinking. I don't need to report my crypto on my taxes. The IRS will never find my crypto. It's anonymous. Stop right there before you make a terrible mistake. There are 4 key ways the IRS can find information about your trades.
I discussed 4 ways the IRS tracks crypto. Let's review those 4 tracking methods and see what's changed over the past 2 years. Toward the end of this video, I'll also share some newer ways the IRS tracks your crypto and what that means for crypto investors. Number 1, exchanges send tax forms. If you've been trading on a crypto exchange, you've likely received a tax form each year. But it's important to know that not all exchanges handle this in the same way. Some exchanges send out Form 1099 Miscellaneous, which reports miscellaneous income like staking rewards or referral bonuses. Others might send a Form 1099B, which details your capital gains and losses from trades. And surprisingly, some exchanges don't send out any forms at all. Now, here's the key point. If your exchange sends you a tax form, whether it's a 1099 Miscellaneous or 1099B, they're also sending that form to the IRS. This means that the IRS knows you have crypto that needs to be reported on your tax return. Over the past few years, the IRS has been using this information to send out notices to crypto investors. These notices come in the form of a CP2000 notice, and the CP2000 notice is a fairly common one. It's essentially the IRS saying, "We think you underreported your income, and here's what we believe you owe." If you receive one of these notices, it's crucial to address it promptly, as it can lead to further complications if ignored. Sometimes, instead of a notice, the IRS just sends you a bill. Whether it's a notice or a bill, these scary letters from the IRS usually catch taxpayers off guard, especially if they weren't aware of the reporting requirements or if the information on the tax form was inaccurate. Number 2, suing crypto exchanges. The second way the IRS tracks your crypto is by suing exchanges and demanding user records. This happened to Coinbase in 2017, where the IRS obtained information on over 40,000 users, and a similar case occurred with Kraken in 2021. Once the IRS has this data, the IRS has sent warning notices to users or went straight to initiating audits. These notices can range in severity, from a gentle reminder to double check your crypto to demanding large sums of unpaid taxes. If you received one of these letters, take it seriously. It's wise to seek a tax professional and legal advice on how to protect yourself. However, today, the IRS suing exchanges is far less common. With the new 1099-DA reporting requirements, exchanges will be required to report this information, reducing the need for IRS lawsuits. Number 3, tracing crypto from a centralized exchange. A third method the IRS has been using for years is tracing crypto from centralized exchanges. Many people still believe that if their crypto is on a decentralized exchange, it's untraceable. But this is a big misconception. If your decentralized exchange ever interface with a centralized exchange like Coinbase, which reports to the IRS, there's a clear trail leading back to your decentralized accounts. To avoid tax problems, it's crucial to report everything. The IRS can find it, and if they can't find it now, they will when you cash out, which leads us to the next method. Number 4, tracing funds to and from your bank account. Perhaps the simplest and most common way the IRS can track your crypto is when you buy or sell crypto. If you've ever paid for crypto with your fiat bank account or cashed out your crypto and moved it to your bank account, that creates a clear trail to your crypto activity. During an audit, the IRS can easily follow this trail and demand your crypto transaction history, and that's why it's vital to keep accurate records. So those were the 4 ways I originally discussed and how the IRS tracks your crypto. But what's changed? Let's go over some new developments over the past 2.5 years. Number 1, final broker regulations and Form 1099-DA. Since our last video, the landscape has changed significantly. Previously, many exchanges like Coinbase, Kraken, and Gemini voluntarily reported users' crypto data using these forms. However, starting in 2025, the IRS will require all exchanges to report crypto transactions on a new form, the 1099-DA, as part of the final broker regulations. This standardizes reporting and will likely lead to even more scrutiny from the IRS into crypto in the years to come. This is a significant shift that will provide the IRS with more information than ever before. As this regulation expands to cover other areas like DeFi and unhosted wallets, the IRS's ability to track crypto will only grow. Even with just centralized exchange reporting, the IRS will have a literal fire hose of information at their disposal. For instance, when you withdraw from a centralized exchange to a wallet, it will be easy for them to see and track those funds. Number 2, bankruptcy filings such as BlockFi and Celsius. When crypto exchanges file for bankruptcy, their financial records often become public, and this information can be a goldmine for the IRS. Recently, we've seen high-profile exchanges like BlockFi and Celsius file for Chapter 11 bankruptcy, and as part of these proceedings, they publicly listed all their creditors, including account holders, which means that your name and account details might be out there. The IRS likely has access to this information also and can use it to identify crypto investors who haven't reported their activities on their tax returns. In fact, we're now seeing BlockFi taking additional steps by filing late 1099 forms for previous years. This means that even if you didn't receive a 1099 at that time, you could still be on the IRS's radar if BlockFi has retroactively reported your transactions. These bankruptcy filings and subsequent actions by the exchanges show the importance of staying compliant with your crypto reporting. If your name is on these creditor lists and you haven't reported your crypto activity, the IRS could be coming after you next. Number 3, information sharing agreements. Binance. In 2023, Binance, the world's largest crypto exchange, reached a major settlement with the US Department of Justice after admitting to violations of anti-money laundering laws and other financial regulations. As part of the settlement, Binance agreed to extensive compliance measures, including the appointment of an independent monitor. This monitor has direct access to Binance's user data, including trading activities and personal information. For US regulators, including the IRS, this settlement is significant because it provides them with increased access to detailed information about Binance's users. This data can be used to identify individuals who have not accurately reported their crypto transactions on their tax returns, making it easier for the IRS to target and investigate potential tax evaders. Number 4, hiring contractors to analyze anonymous wallets. The IRS has boosted its ability to trace and analyze cryptocurrency transactions by partnering with Chainalysis, a leading blockchain firm. Chainalysis provides the IRS with advanced tools capable of tracking transactions across various blockchains, including those so-called anonymous wallets and privacy coins like Monero. Beyond just supplying technology, Chainalysis plays a critical role in training IRS agents, equipping them with the skills needed to conduct sophisticated investigations into crypto activity. This partnership has already led to significant successes, including the seizure of billions of dollars in cryptocurrency. And that's how the IRS tracks your crypto. Always, always, always report your crypto. Get it right the first time to save yourself from future headaches. If this video helped you out, hit that like button and subscribe for more updates on staying ahead of the IRS. Got another way they might be tracking you? Drop it in the comments below. We'd love to hear it. And don't forget to follow us on social media for more tips and insights. If you need professional help navigating crypto taxes, audits, or anything else, visit us at gordonlaw.com. You can find the link on our channel, and be sure to check out our blog, which has tons of tax and legal resources for crypto investors. We've got your back. Thanks for watching, and see you next time.